Before we read through this example, I just want to emphasize that it is extremely important that you ensure that you know when you look at a scenario, is this PPE in terms of IAS 16 or is this investment property in terms of IAS 40? You should be able to identify the accounting policies in terms of your revaluation surplus or your cost model. That investment property can also be included at cost model and then at fair value. You need to ensure that you are familiar with your IAS 36 impairment principles and, extremely important, your IAS 12 principles. Right, now we are looking at PropShop Limited with a 28 February financial year in. Property 1. On 1 January 2017, PropShop acquired a property for use as its administrative headquarters. Therefore, immediately identify IAS 16. This will be PPE. They use this property. Details of the property are as follows. Cost on 1 January 2017. Land, base cost 480,000, 480,000. The building with a base cost of 1681920. The useful life of the building at acquisition was estimated at 25 years. Then, fair value on 28 February 20.22 and 20.21. Land 1080,000, 840,000. Building 2040,000. On 1 August 20.21, PropShop vacated its Rivonia administrative offices and leased the building to ABC Limited. Look at this. Now they lease this building. Therefore, we are able to identify IAS 40 investment property. Therefore, this was IAS 16 property, plant and equipment. But from 1 August 2021, they lease this property out. Therefore, on 1 August 2021, the fair values were as follows. Land 900,000, building 1.920000. Now, why is this important to us? When there is a transfer, you need to know that you will have to transfer this property out of PPE at fair value and include this into investment property at fair value. Therefore, we need to identify, if you look at our first section, it's PPE, now we transfer this to investment property, that this adjustment from our carrying amount to our fair value should be treated as a revaluation. Very important. This adjustment should be treated as a revaluation. Right. Then, the South African Revenue Service did not allow any deductions on property 1. We're able to identify that this is an administrative property. Therefore, think about IAS 12, 15 exemption. The revaluation surplus, look at this, on the date of transfer to investment property will be 546432. Through OCR. Therefore, guys, that indicate to us what is this revaluation surplus. But you should be able to calculate this as well. Then, on the date of transfer, the correction of deferred tax resulted in a decrease in the deferred tax liability of 103,230. Now, why a correction? Why a correction of deferred tax? Because if you look at this, previously, this is PPE. Therefore, what is the manner of recovery? The manner of recovery for PPE will be through use for tax purposes. But for investment property, we will look at through sale. Okay, therefore, this is important. Our deferred tax will change due to the fact that this was calculated based on use, and now we need to calculate our deferred tax based on sale. Then property 2. On 1 December 2020, PropShop acquired an investment property in Pretoria immediately know IAS 40, this is investment property, at a cost of 7.2 million, 4.8 million of which can be allocated to the industrial building. The building was immediately leased to a manufacturer. The fair value of this investment property at the end of February was as follows. 2021 for the land, 3 million, building 5.64 million. 2022 land, 3.444, and they don't provide this in terms of our building. Right, now, on 1 September 2021, PropShop issued the lessee with a 1-month written notice to vacate the industrial building since they required the premises to conduct manufacturing operations. From 1 October 2021, the industrial building was used by PropShop to accommodate its own manufacturing operations, and the remaining useful life of the building was estimated at 40 years on this date. Immediately identify that we will have a transfer from investment property to PPE, and we need to follow our IAS 16 rules. Now, this transfer, at date of transfer, we need to identify that this should be at fair value. Therefore, we need to take this out from our investment property at fair value and include this in our PPE at fair value. Then the fair value of this property on 1 October 2021 was as follows. We have our land, 3240000, and our industrial building, 5990400. Now, the industrial building qualifies for a deduction of 5% per annum, not apportioned for part of the year on cost in terms of section 13(1)(b) of the income tax. On the date of transfer, again, the correction of the deferred tax amount to an increase in the deferred tax liability of 69043. Now, why? Again, if you look at this, before the transfer, investment property manner of recovery will be through sale, and PPE manner of recovery will be through use. Right. Other information. All investment property is subsequently measured according to the fair value model. What do we need to remember in terms of IAS 12? Our fair value adjustments will be based on our CGT. Land classified as property, plant and equipment are accounted for according to the revaluation model. Also important to us in terms of IAS 1251, we need to know that the adjustments will be based on CGT, and then buildings classified as property, plant and equipment are accounted for according to the cost model in terms of IAS 16. Buildings are depreciated over the useful lives according to the straight line method. Then we have our profit before tax for the year ended 28 February 2022 amounted to 7608000 after, look at this, after taking the above information into account. Assume a normal income tax rate of 29%, capital gain tax inclusion rate is 80%. Now, required. Disclose the following notes of PropShop Limited for the year ended 28 February 2022 in accordance with IFRS. A. Your income tax expense. Paragraph 1280 and 1281C. What do we need to know? We need to include our tax rate recon, but they did not have to tell you this. You need to know this. B. Property, plant and equipment and investment property. Then please note comparative figures are not required. Round of all amounts to your nearest rand. Now, extremely important as always, if you do not know what to include in your note, I recommend that you open your standard at the selected disclosure sections and identify what you need to include. Now, before we start to attempt this question, it's extremely important that you always just think, ensure that you understand the scenario. We tend to start off by just writing and think that we know what they're actually telling us in the scenario. But if you spend a few seconds and just ensure that you understand the scenario, it will help you to gain maximum number of marks in your questions. Now, if we look at this, they've indicated to us that they have two properties. We have a property 1, which is a transfer from PPE to investment property. We have a property 2, which is a transfer from investment property to PPE. How do we account for these transfers? Important. At date of transfer, at fair values. Therefore, we need to take this out of our PPE at fair value and include in our investment property at fair value. We need to take this out of our investment property and include this in our PPE at fair value. Therefore, what is the accounting policies? You need to ensure that you understand what you need to do when we apply our fair value model. Then, what are the tax rates? Guys, this is important. Ensure that you understand. And remember your IAS 12 principles. Therefore, when you look at the left side, just a brief summary. If we look at our investment property, if it's at fair value model, our fair value adjustments will be taxed based on our CGT rate. If this is PPE, our PPE will be divided into land, where we have our revaluation model, and this will be taxed based on CGT rate. If we have our building cost model, manner of recovery through use, therefore your normal 29%. Now, if we take this one step back and we only look at property 1 for now. Property 1, we have identified that this is PPE from date of acquisition until 1 August 2021. Therefore, if this is PPE, important, remember follow IAS 16. Therefore, our building will be depreciated. But let's first have a look at our land. In terms of our land, based on our revaluation model, we need to revalue our property on date of transfer. And that difference will be recognized as a revaluation surplus. And the manner of recovery will be through sale based on our CGT rate. If we look at our building cost model, we will have to depreciate our building up until date of transfer. We need to then determine our carrying amount in terms of IAS 16, then obtain the fair value, and that difference we will treat as a revaluation surplus, even though this is a cost model. But we treat this in terms of our rules of IAS 40 because this is a transfer. Therefore, again, guys, take out at fair value and include at fair value our investment property. Right, investment property at year end, we will have to revalue at fair value and CGT rate will be used. Right, property 2. Property 2 was investment property at fair value. Therefore, manner of recovery through sale, CGT. Right, now at transfer date, we have to revalue this property at fair value, and then the fair value will be used to include in our PPE. Okay,